Zulily gets a $2.4 billion lifeline being acquired by QVC's owner. What could this mean for other e-retailers like Etsy? I'm Matt Miller in New York for Emily Chang, and this is Bloomberg West. Coming up, Dr. Dre gives Apple Music a trial run. Plus, is the Amazon model a harbinger for workplaces of the future? And Jack Ma uses his own money to buy back Alibaba shares. All of that ahead on Bloomberg West. First up to a story that we're watching right now. The IRS data breach we reported on in May is getting much bigger than we realized. We are now learning of an additional 220,000 possible victims. That brings the total number of taxpayers potentially affected to 334,000. For more on this story, let's get to Washington, D.C. and Bloomberg News reporter Jordan Robertson. Jordan, what can you tell us about this new breach? It seems to be more focused than the original breach that we reported on.
Yeah, the important thing to remember about this IRS breach is that while we're not talking huge numbers, we're talking about 300, 400,000 people at this point, these are highly targeted attacks. And the way that the attackers were able to gain access to previous year's tax files was they already knew a lot about these victims anyway. So they were going after individuals who they believed, allegedly, they could get a really big refund from if they committed tax refund fraud.
So how did they get in? I mean, this isn't the case of them going through each person's individual account, right? They breached the IRS system at large.
They breached the IRS system, but what they were doing was they came in armed with a lot of information about their potential victims, potentially social security number, date of birth, things like that. So somehow they'd identified individuals who they believed were probably high net worth individuals, for whom they could get a very large refund. And they actually did. I mean, they likely used computer programs to do it, but they went kind of one by one, accessing their accounts to get previous year's tax refund information. And then the theory goes, the point of this attack is to file fraudulent refunds for the current year or subsequent years. And it's kind of a painstaking process, and it's one we don't often see in hacking attacks. And actually attacking the IRS directly in this way is probably the hardest way to do this. I mean, you can steal enough personal information or buy it, on the internet to do tons and tons of tax refund fraud. There's billions of dollars a year done with it. So hacking the IRS directly is actually kind of a hard way to do it.
Right, and of course, the way that they did it is more difficult to defend against. Jordan Robertson, thanks for covering this story for us, our reporter in Washington. Now to our lead. QVC parent company Liberty Interactive is buying Zulily for $2.4 billion. Zulily operates daily flash sales on items like maternity clothes and toys for newborn babies. It went public in 2013. Shares soared initially, but as you can see by this ugly chart, they've since dropped 66% in the past year. So what does Zulily offer QVC? Bloomberg News reporter Alex Barinka is here in New York with more. We also have Tasman Consulting managing principal Shari Yocum in Mountain View, California. She helps companies like Dell and LinkedIn integrate staff and properties after an acquisition. She worked at Cisco for 10 years, watching over 50 acquisitions. Shari, let me start with you. Is this a case of finding a company with a large user base and then buying it on the cheap after the market punishes it?
Well, I think they're getting a number of things. I mean, they've got, Zulily knows their market well. They've got that mothered base, right, of 25 to, say, 35 to 40 range that's very committed and really enjoys that site. So that brand is really strong. So they're picking up a really strong brand. They're also picking up a strong leadership team with experience with Blue Nile and Red Envelope. So I think this is a smart move with QVC to expand. And from a Zulily perspective, hopefully this will expand some of their sales where they've struggled.
Alex, why has the stock gotten punished? I mean, the chart looks horrendous. What has Zulily done wrong?
We've seen it with a lot of these internet companies. As soon as you start to see sales growth slow down, there's sometimes a little bit of a knee-jerk reaction. There's a story out on Bloomberg in the last 10 minutes. Paul Sweeney, analyst at Bloomberg Intelligence, says that, this is potentially a lifeline for shareholders because for these internet companies, we've seen it with Zulily, we've seen it with the likes of Groupon, eBay last earnings day. As soon as that top line kind of starts to contract for these companies who don't make a lot on the bottom line, shareholders sometimes can head for the hills.
There are some similarities, Alex, between Zulily and Etsy, right? I mean, Etsy shares don't look quite as bad. but are you hearing from shareholders there that they'd like the same kind of lifeline?
You know, not quite yet. It seems like Etsy, they've been public for almost 2 quarters now, so it seems like they have a little bit of time. They're still preaching this international sales expansion plan. But, you know, turning back to Zulily, they have had that time in the market. They have had the money from the IPO and the opportunity to try to find growth. And while it might be a new sub-segment of customers for QVC, it seems like they've kind of had a slowdown. Sales only 4% last quarter, which fell off quite a bit from the double-digit sales growth in quarters previous.
All right, so let's touch on that, Shari. I mean, you specialize in integration. How will QVC, or how should QVC integrate Zulily to keep it, you know, a separate and strong brand, but also to kind of try and boost those synergies, as corporate executives love to say?
No, that's definitely important. I think protecting the brand would be one of the first things you'd focus on, right? Really protecting that Zulily brand so you don't lose your current customer base. And then find a way to expand that. I do think there are possible synergies. They are different in the way the back end, kind of their shipping and the way they buy. So not sure how much they can get there, but they definitely can get something maybe in the way they source their products. Very similar, they're going for that unique product, going out in the market. So I definitely would focus early on trying to find some of those synergies where it makes sense without eroding the brand or hurting the products, the portfolio.
Alex, you know, we talk about Etsy comes to mind immediately because it's about a $2 billion company. But in general, you mentioned a lot of these tech IPOs follow the same pattern, and you're seeing a lot of these real niche retailers come out in this size. Are we expecting to see a wave of M&A here?
But potentially. We've already seen a little bit of that. When you think of eBay just bought a consignment startup twice. You have Yahoo buying the kind of edgy fashion startup Polyvore. Richemont, who has Cartier and Montblanc, just bought Net-a-Porter. So we're starting to see a bit of this where these newer companies are really owning a certain market and really attracting a certain type of customer. But once they saturate that, that's when they start to struggle with growth. And some of these bigger retail players are also looking for growth in these kind of really committed, loyal customer bases. So potentially more of this going forward. Doesn't mean somebody can't kind of break the mold and turn into the next Amazon. But, you know, right now it's a kind of wait and see process for some of these smaller companies.
All right, Alex, thanks very much. Bloomberg News reporter Alex Barinka covering this for us, and Tasman Consulting managing partner Shari Yocum. Appreciate your time today. All right, now, a story that we're watching. Last week, we learned Alibaba planned to repurchase as much as $4 billion worth of stock over the next 2 years, an effort to revive a share price that's been beaten down 28% so far this year. Now we know that billionaire co-founders Jack Ma and Joseph Tsai are personally helping fund that buyback, according to a regulatory finding, but we don't know just how much they are spending. According to Bloomberg Billionaires Index, Ma is worth an estimated $31.5 billion and remains the second richest person in China, so he could afford to buy a lot if he wanted. Still ahead, why one Apple supplier plans to invest billions on next-generation display screens. We'll bring you that story next. Plus, music streaming site SoundCloud could be close to a landmark licensing deal with Universal Music, but at what cost? And before we head to break, these people entering a cash grab machine are not contestants on a game show, but employees at GoDaddy. The company uses the machine as a way to reward employees for meeting customer service goals. On average, they can pocket between $600 and $700. Now to Apple's supplier LG Display. It is planning to invest about $8.5 billion over the next 3 years to develop next-generation screen technology. The investment will be focused on advanced displays called OLEDs, flexible displays, and high-end LCD screens. These OLED TVs are said to be more expensive and more difficult to produce than LCD TVs. This as Apple expects to announce new products in early September at their annual event, including a newer version of the Apple TV. That's the set-top box, not an actual television. Joining us now to discuss all things Apple is Bloomberg News reporter Adam Satoriano, and with me in New York Stephen Pulverant of Bloomberg Pursuits. Adam, let me start with you. It's kind of confusing because we talk about Apple TV in three different ways. One, a content streaming service that they've now been said to put back to 2016. Two is the box that sits on top of your console and plugs into your television. And three, probably most excitingly, is an actual television screen. Does this investment in OLEDs by their supplier LG mean that Apple's going to use that technology for its actual television?
The signs so far point to no. Apple has all their efforts into television right now have been focused on the set-top box and then striking deals with media companies to get content to play through that service. The television business is a very tough one to make a lot of money in, and lately it's been kind of a race to the bottom with a lot of Chinese suppliers being very competitive on price. And so Apple, which has profit margins well over 30%, I don't know if that's an attractive business model for them. And so they've been focusing more on the set-top box and this content play.
All right, so Stephen, let me ask you, is an Apple TV something that consumers are clamoring for, or do we not even need that sort of product?
I don't think consumers are clamoring for that product necessarily. I think there are enough good televisions, and like Adam said, enough good inexpensive televisions that a kind of luxury TV from Apple isn't something people necessarily need or even want.
All right, so let's move on then to the Apple Music story. Dre recorded his first album, since The Chronic? It's been a long time since Dr. Dre has come out with a new record. He put it out on Apple Music. Adam, how did it do?
It did quite well. They reported some numbers that come out, and they had millions of streams, and they sold 500,000 downloads through the iTunes store itself. And I think what this album does is it points to some of the stuff that Apple's going to be doing to get people to subscribe to Apple Music, which is to have things that are exclusive to the service. So somebody who's on Spotify can't get a copy of the new Dre album, but so that they might subscribe to Apple Music as a result. And if you can get more and more of those types of deals done with high-profile artists, it can give the service a leg up on some of the other ones. But that's a tough thing. That's a tough thing to do for a lot of artists. Especially because it's got lower subscribers than Spotify.
Yeah, Stephen, we're just showing video of you when you took Apple Music for a test run. How do you think it's doing so far? There's so many streaming music services now, but I feel like once you have Spotify, there's no real reason to get anything else unless you're a total Dre diehard.
Sure. Getting people to switch over, I think, is the biggest friction point for Apple right now. People get set in their ways. They use one service. Everything's the same price. It's mostly the same catalog. It's pretty difficult to get somebody to move over. Spotify's paid subscribers versus Apple's paid subscribers. Spotify's got about double, but they also are an established player. For Apple to move out of this free trial period and expand, I think is going to take some time.
All right, we got 30 seconds left. Adam, set us up for the September Apple show. What are we going to see? Do we get a new phone? Do we get a new watch? What's coming out?
The biggest thing is going to be the phone. Although a lot of attention gets put onto some of the new stuff that Apple gets introduced, whether it's a watch or some of their plans in television, the business all comes back to the iPhone. And so as the iPhone goes, so goes Apple's business. And if they can continue to increase sales of that product, the company and shareholders are going to continue to love the company.
Is it the 6S? Are we calling it the 6S or?
That's most likely. That's the trend it's been.
All right. Adam Satariano joining us from San Francisco. Thank you very much. He covers Apple for me. And Stephen Pulverant from Bloomberg Pursuits. Appreciate you stopping by as well. Now, I want to tell you about a story that we're watching involving a streaming music service. SoundCloud is said to be close to confirming a landmark licensing deal with Universal Music Group. That's according to Music Business Worldwide. Talks between the two have dragged on for several months because Universal is asking for a big chunk of equity in SoundCloud. However, the report says SoundCloud investors, who were spooked by Sony's decision to actually pull music from that service, have pressured pressured the company to reach agreements with other major rights holders. Back in November, Warner Music reached a deal with SoundCloud and took a 5% stake in the business, so you could see this get done for around that amount. Now, staying in this space, a French music streaming service called Deezer may be joining the global unicorn club. The Spotify rival is said to be seeking funds from investors that value it at $1.1 billion. Deezer isn't in the U.S., but focuses instead on expanding in Europe and emerging markets. Coming up, Silicon Valley defends Amazon's corporate culture. Do you need to be ruthless in order to be disruptive? We'll talk about that. And cord cutters hitting the media stocks hard last week. But just how fast is the American home deciding to get rid of cable? The numbers could surprise you. Time now for the Daily Bite. One number that tells us a whole lot, and today's bite is 566,000. That's the estimated number of lost subscriptions for pay TV from April through June, according to analysts at MoffettNathanson. The sector is declining at an annual rate of 0.7%. That may not sound like a lot, but over the past year, 2 million households cut cable TV or decided not to purchase it. Media stocks plunged last week on concerns about cord cutting fueled by Disney's admission that ESPN had lost a modest number of customers. But if this continues, it'll be a continuing problem. Amazon CEO Jeff Bezos is defending his company culture after a New York Times expose painted a grueling picture of life as an Amazon employee. The article makes some serious allegations. Sick workers being told they weren't focused enough at work instead of being given time to recover. And employees, being warned over taking vacation in places with poor internet. Bezos addressed the article in an internet email to employees, but other tech leaders have been commenting. Former Twitter CEO Dick Costolo tweeting, "This has taken out of context, stamped all over it, and symptomatic of growing reliance on hyperbole to score points." And in response to a line describing Amazon as a place where overachievers go to feel bad about themselves, Andreessen Horowitz chairman Mark Andreessen posted, well, given the number of workplaces designed for underachievers to feel good about themselves, ... Joining me now is Pro.com CEO Matt Williams, who spent 12 years at Amazon, and Boyden Global Executive Search Managing Director Jeanne Branthover here in New York. Jeanne, let me start with you and ask, really to Jeff Bezos's point, wouldn't it be difficult to recruit workers given the fact that there's so many Silicon Valley firms that are so great to work at?
It will not be difficult to recruit for Amazon, period, even with all these articles and the news stories. Amazon has an incredibly good name, but more importantly, not every person is looking to be in a place like Google. There are truly brilliant people that want to push themselves, they want to be better, they want to make an impact, and that's what Amazon does. They look at these people as Olympic athletes. They really are the best of the best. They're used to working hard. They're used to getting turned on by creating innovative things that go out into the marketplace. So there's people that truly prefer an environment like Amazon.
Matt, what do you think? I mean, we've heard this time and time again, and Bezos can deny it, and obviously his buddies at other Silicon Valley firms can defend him, but surely it's a stressful place to work. Surely it's a competitive environment, and the treatment of, the lower level employees is definitely lacking.
Well, I will tell you firsthand that it is a high-demand, high-intensity workplace, but that is what makes it one of the best places to work, if not the best place to work in America. And I will tell you that a lot of what I read in the article and the story, if they were anecdotes chosen from perhaps an occasion over the years, I have never seen any of those things happen inside of Amazon. And in fact, I have many, many friends who, love working there. I would work there again. It is the best place to work if you're into high-demand, high-intensity workplaces that change the world.
Well, we know for a fact, because of the Supreme Court case last year, that some employees are made to wait 30 or 45 minutes to go through security checks, and Amazon insists on not paying them for that time, which doesn't make any logical sense. Why did you leave, Matt? Well,
I had an opportunity to go be the CEO of a social news website, dig.com, and moved down to the Bay Area. So I had a very personal choice at that point, but it is certainly not because of the people, certainly not because of the culture. In fact, I would challenge anyone to name a company that has over 100,000 people that can have the consistency of culture, the relentless focus on customer that Amazon's had.
So, Jeanne, this is a defense that we hear of a lot. On the other hand, you look at LinkedIn and you see junior employees leaving after 6 to 8 months. The company has an incredibly high turnover, as proven out by the numbers, regardless of how great it is, to work in that kind of competitive environment.
There's a lot of companies that will brag or talk about how good they are to the employees and they make life so easy and they make sure they're having fun while they're working. Honestly, when it comes to really intelligent people who want to create, who want to be innovative, as Matt said, you really are not looking to be coddled. You're looking to be pushed. You're looking to be the best. You're looking every day to achieve something that maybe you didn't even think you could achieve. You want to be surrounded by the best of the best. And that's the environment that Amazon really creates. So the reason that there are ex-employees that I talk to that say it's the best place they ever worked in their entire lives. Some people really regret leaving, but most people that leave that are really superstars leave because they get unbelievable offers to go do something else fabulous that they would not have gotten if they hadn't been at Amazon getting the experience that they got.
How important is the compensation there, Matt? I wonder what you think about the fact Corey Johnson this morning was just saying a lot of people go to work there because of the stock-based portion of the compensation, and we just showed a chart of the stock. It's obviously done incredibly well. Is that, you think, an important point to draw talent and kind of a way to, honey to a bee, maybe?
I think the results speak for themselves. I think to the last point that was made, Amazon is not a day camp. Amazon is not a country club. It is a place, if you want to go work hard and change the world, that is where you go. And I think the compensation is truly, the data speaks for itself. The fact that Amazon has not only sustained but grown so tremendously over the past several years is hats off to the employees that worked hard, that kicked butt, and that were able to deliver something amazing, something that very few companies in the world have ever been able to obtain, and they were rewarded for it because the stock-based compensation allows for that. And that is a core part of the culture. Work hard, and you will be compensated for it.
All right, Matt, thanks so much for joining us. Pro.com CEO Matt Williams there. Boyden Global Executive Search Managing Director Jeanne Branthover. Always appreciate seeing you here at Bloomberg as well. I think we may be conflating the problem of the average worker putting stuff in boxes at a warehouse and creative executives who are getting stock options, but I'm sure we'll talk much more about this in the future. That does it for this edition of Bloomberg West. Tomorrow on the show, we're talking tech in the run-up to the 2016 presidential election with CrowdPack CEO Steve Hilton.